everybody, if I can get your attention. Notice how I start talking and the men go running. I don't get this, but it's my talent. So I want you to have an idea of what's going to happen tonight. We still have some more people who are supposed to show up, but traffic, weather, human nature. So I'm going to talk for a little bit. I'll introduce Ben, tell you some great things about him. And then when I stop talking, the waitress is going to come in and take everyone's order. And then after she does that, then Ben will start talking. And then when the food comes, he'll quit talking, and he will introduce his colleagues that he's brought here. So I just want you to know kind of the lay of the land. Amy will bop you if you don't take a coffee cup out, and she's small, but she's fierce. So Amy's going to kick me later for saying that. But the first thing, I've had a few of you this year, especially this year, ask, how am I supposed to invest this year? The market's a mess. Cryptocurrency, which sadly I'm involved in, but mine did not die like the other ones have, although it's not done well. So I have no answers. I am not a financial planner. I use a financial planner, and that always amazes people. Like, Carol, you work with money all the time. I work with taxes. I can minimize your taxes. But what to invest in? I think half of you I've told, if I tell you of a stock to buy, watch it for 3 days. It'll go down. I don't have that skill set. Anything I buy and I hold, and sometimes that's to my detriment. So we have the experts, and they're here in this room. So some of you, I actually wrote it down, asked what a financial advisor does. And they are educated professionals that help you set up financial goals and help you achieve them. And it's not just retirement. So many people say, oh, well, they're going to help me retire. They can help you buy your first home if you're young. They can help you with paying for college for your kids. Maybe you always wanted that, that lovely yacht to go around the lake with. Whatever your goals are, they can help you achieve them. And mainly they help you achieve them by listening to you and setting realistic budgets with you. Now, budgets can be a 4-letter word, but if you're going to achieve something, the only way you typically get there is by regularly working towards it, as me losing weight. If I would stay focused, eat less, and exercise more, I would do the right thing, and I would be more svelte. So obviously, I have a hard time too. So we need accountability partners, and that's what a financial advisor can be. Now, Ben's a fiduciary, and a fiduciary is kind of unique. He is educationally, ethically, and legally obligated to put your interests in front of his. You guys are mainly old enough that you remember the annuity scams from 20 years ago, where the guy who sold the annuity made more money than you would ever. They still have annuities, and they are so much better than they used to be. But Ben has to legally put your needs in front of his. And that's important. With whoever you work with, you want to make sure they're fiduciary. You can expect him to review all your current investments to assure you that the fees are reasonable. Because sometimes you're in a 401k that you were in from a company 20 years ago, and the quarterly fees are ridiculous. I don't know that. You don't know that. Ben would know that. So it's nice to have an extra pair of eyes. And then he wants to make sure that you're getting the right rate of return and that your risk is where you think it is. When we're younger, we all set our risk. We were ready, go all tech stocks were great. As we get older, we tend to be a little bit more conservative. But if you have your old investments in that higher risk thing, where your money is might not be where you should be. So that's why we have him. And he is offering to everyone here a free, no-cost meeting to ensure that where you are and that it's a good fit for you. So the other thing is you want to make sure someone's a fiduciary. You want to make sure that they're vested. And I've checked him out. And you also want to make sure that you get along with them. So if you meet with somebody, and I've had this discussion with everyone here, when you met with me, you want to make sure we're a good fit. Do we communicate? Do you trust me? Do I trust you? It's a mutually beneficial relationship, and it's so much so with someone who's helping you to plan your life. So for that end, this is Ben, and as soon as we place our food order, he'll come up and he'll talk to you. And by the way, save questions to the end, but if something is dying, put your hand up, he'll call. All right, everyone, I want to introduce you to Ben. And again, if you have questions, you can raise your hand and ask. or at the end we'll have a question and answer period, and obviously there's time for discussion. So here is our presenter.
Presenter.
I speak good English.
Thank you.
You're welcome.
Thank you. All right, so good to see everybody tonight. My name is Ben Belluri. I'm with Edward Jones. My office is in the University area of Charlotte, so it's great to be here tonight. I met Carol a couple years ago when I first came over to Edward Jones. I'm going to share a little bit about me, a little bit about Edward Jones, and then I'm going to turn it over to the real rock stars tonight, Steve Mazzarell. But I'd like to share with you just a little bit. I moved up here to Charlotte in 1998. I grew up in Middle Georgia, went into the Air Force right out of high school, spent a few years in the Air Force, came back home to Georgia, got really excited about financial services, and said, hey, I've got to move up to Charlotte because that's obviously the place to be. Came up here in 1998, got started my career with Vanguard, did several years out there, graduated from Queens in Charlotte, and then ended up going to TIAA for a long, long time. And out of that, eventually moved to Edward Jones. The reason that I went to Edward Jones was because, one, it's a private firm. We are not publicly owned, so we don't have to answer to shareholders. We have to answer to our clients. We're a partnership. So we have, folks at our firm that actually own the firm itself. They have a fiduciary interest. You kind of heard a little bit about that. So we don't like to be in the news for the wrong reasons, because if we are, that comes out of our partners' pocketbooks. So we're a conservative firm in a lot of ways. We don't do speculative investments like Bitcoin or cannabis stocks or anything of that nature. We believe in just having a disciplined, long-term approach to helping you meet your financial goals. So the way that I do that, I meet with all my clients. We go through, a very established process that we have, a 5-step process to learn what's important to you, what kind of things are you trying to achieve. And then I work with you to kind of develop a strategy and a plan of action that we put into place, and then we partner together to make sure that it stays on course until you get to the point that you can achieve financial freedom and or create generational wealth. That's really what we're all about. So I love thinking about, one of the things that I really am excited about that we do at Edward Jones is think about how do we help people really create and leave meaningful legacies. So it's really nice to partner with somebody like Carol and her clients and think about ways to be more tax efficient and really create and maintain those legacies for folks while they're living and when they're gone. That's a really exciting part of our partnership with my clients. So that's really a lot about Edward Jones, a little bit about me. But here's really, again, the reason we're here tonight is because you got questions about what is going on. I know that I've heard this since I started with Edward Jones in March of 2020. From the first time I started talking with Carol and we've kind of started sharing ideas and things like that, it's been the same tempo ever since. When are we going to come out of this market? And obviously there are some principles that we feel like people should take away. Well, Edward Jones has done a great job in our 100 years, not mine, Edward Jones as a firm, of partnering with other investment companies who have the same types of attitudes and principles that we do. One of those companies is MFS. As a matter of fact, to my knowledge, I believe MFS was the first mutual fund.
That's right, 1924.
The first mutual fund in existence. They've been around since then, so they know what they're doing. And we are so excited tonight to have one of our gracious product partners here by the name of Steve Mazzarell. So Steve graduated from Rutgers University, and he got his bachelor's degree there. He has a chartered mutual fund counselor designation, which comes from the College of Financial Planning. He also holds a Series 6, a 63, and a 65 from FINRA. He has spent time, he started in financial services back in 1994. He's worked with companies like New York Life, Mainstay Funds, JP Morgan, and most recently since 2007, Steve has been with MFS. So he has a lot of experience, not only in the industry, but with his firm. He supports advisors like me throughout Western North Carolina and South Carolina. And basically, he is our go-to guy. When we have questions about, Steve, what's going on? when is this gonna, when is this gonna alleviate? That's where we have Steve step in and share with us. And so tonight, Steve is gonna spend some time sharing with all of us some principles that I think you're gonna find to be very helpful in your journey as you continue toward the goals that you're trying to establish for you and your families and such. So I'm gonna leave it for Steve.
All right, well, good evening, everybody. I always feel like Alfred Hitchcock when I say good evening, but this is fun. It's great to be with you all again. I'm still, after 20-some years of doing this, I get a thrill out of being able to do this together. Because who in the world would have thought for a couple of years there we'd have to do this electronically and through a screen? So it's a wonderful thing to be back together with y'all. Ben, thank you so much for the introduction. Just real quickly, Mom always said when I was growing up, consider the source, right? Consider the source. Know where you get your, and it's important now more than ever, right? Know where you're getting your news and information from. I'm not Anderson Cooper. I heard it before. I'm not. I get it. If I put the glasses on, it'll be even worse. So I'm just going to leave it there. So I'll give you a quick rundown on my background in MFS. Although Ben, I think he hit every detail there. That was great. And then what I want to do is talk about some, really some timeless principles. We'll put it into perspective in terms of what we're going through now. I'm not going to ignore where the markets are. We can talk openly about that. I'm happy to answer any questions. But some of the timeless principles, that'll be the first book that we go through, which is in front of you there. It looks like this. To make you feel comfortable in Miss New England, we made that really a frigid looking picture, right? So this is going to be the first one we go through. And if you've got a pen, if you want to check off a few of these, if you flip open the first page, it's 1, 2, 3, 4. We're definitely going to spend time on those. Right across here, and we'll go through. Oh, it's the other one. Yep. And then we'll move on, and we'll finish with a case study, which is in your second brochure, Calm, Cool, and Invested. Okay. So we'll go through that, but really quickly consider the source. Okay. I moved down here in the very end of 1995. So, matter of fact, my home was no more than a mile from this location, oddly enough, and it has changed immensely. I now live down in Union County, out in Waxhaw, so I'm local. And for the last 27 years or so, really my entire purpose in my career has been helping financial advisors help their clients. And that's it. So to clarify all that, I have the licensing to do the advisory job, but I'm not an advisor. I couldn't do the things for you that Ben can do. Right, so I would help Ben. My job, once again, as clear as I can make it, in situations like this, running analytical illustrations, putting together some ideas, it's to help an advisor help their clients. Married 30 years now, go figure. I've spent just over 5.5 years of nights in Marriott hotels during my marriage. I think that's a key to being really happy. That's helped a lot. And in that time traveling, I've got 2 kids who are up at App State. Terrific time of our lives, and I love this time of year too. So if we don't say it, have a great Thanksgiving, and as we kick off Christmas and the holiday season, this is a great time. So with that in mind, let's jump in here. MFS, really quickly. We did invent the mutual fund back in 1924. Wasn't there for it, but you can Google this, I promise you. If you Google America's first mutual fund, it's going to come out, Massachusetts Investors Trust. And just for a second, we kind of take for granted what mutual funds are all about. But if we went all the way back in time to 1924 and you tried to buy 1 share of stock, well, you couldn't. You have to buy big lots. General Electric was around back then. It was actually one of the first holdings in that first mutual fund. So GE, right? It was trading at $232.25. I bet some of you remember when stocks were priced in fractions. Not too long ago, but $232.25. That was about 9 weeks of earned income for one average U.S. citizen back then. The stock market, the ability to invest, we take it for granted now. It's incredibly easy to do. But it was inaccessible until the advent of the mutual fund. And that's what our background is. So I think the tie-in with Edward Jones is important. 98 years in the business, not me personally, sorry. 98 years for MFS. Edward Jones 100. There are very few firms that have been around a century that are still doing what they were designed to do. So I think we're in good company in that regard, and I encourage you, meet with Ben, sit down. It's always helpful to get a second set of eyes on what you're doing. And I'll explain too why I'm passionate about that. Don't do this alone. Okay, so let's jump into the first book here. We'll turn to page 1. Oh, sure. Is it this one? There you go. Joseph, you breaking things? Jeez, it's like having my son here. He's just going to be disruptive and break things. All right. Understand market movements. Number 1, okay. Busy chart, but here's what it's all about. We're going back 40 years. Everybody remember 1980? Great music back then, right? 1980, we go all the way back. Just some perspective. If you went to a bank in 1980 and bought a CD, any idea what rate you'd be getting? Well, how much? There you go, mid-teens, absolutely. Mid-teens! Sorry, but inflation was almost exactly that as well. So it wasn't all that great time. But back in those days, and we'll talk about inflation in a minute too. Back in those days, it was a different time, right? Well, let's just take a look at what happened in the stock market that year. If you look far left, you'll see that bar with the number 26%. That's telling you that in the calendar year 1980, the stock market, represented by the S&P 500, delivered a 26% return. Is that good or bad? It's outstanding. It's about 2.5 times what we would expect based on history. Going back over 100 years, approximately 8 to 10%. If you just have that as your expectation, right? Expect 8 numerically. It's been about 10, but about a 10% return. So we'll get 26%. But guess what? If you didn't invest the entire year, you didn't get 26%. So if you look down, you're going to see every single one of those years going left to right has a gray diamond. Do you see that? Any idea what that means? 1980, negative 17%. Intra-year, at one point during 1980, you were down 17%. And you probably weren't going to open up your envelope, your statement that month either, right? Okay. If you work from left to right, you're going to see a lot of similarity. You're going to see that 1 out of every 4 years, matter of fact, the bar doesn't go above the midline. It was a negative year. 3 out of every 4 roughly have been positive. Those are good chances. That's good. But as we expand our time out, that's where the magic really happens. I'll show you that in a moment. But my point here is that in any given year, anytime there's a good 26% return, you're going to have to withstand a 17% or even greater, in many cases, loss. Does that make sense? So understanding these market movements and knowing that they can happen occasionally, actually frequently, prepares us to stay invested. So we have to understand logically, right, how these markets work. That was 1980. Let's go from left to right and just go through, because my memory gets a little bit more clearer as we go through. In 1994, you'll see a negative 2%. That was a negative year for the stock market. So that was one of those, like 1 out of every 4. And it was a negative 9 at one point. Anybody remember what was going on in 94? Music didn't get any better. It actually got worse. But that's a different point. But 94, a lot of things were happening. But in the financial world, the Federal Reserve was raising rates. Alan Greenspan was the chairman of the Federal Reserve back then, looked like an actor from Hollywood. It was exactly who should be the chairman of the Federal Reserve. But what he did was he raised rates. We're getting, the Fed is raising in a big way now. But up until 94, that was the big one. And he was doing it in erratic ways. There were some moves of 25 basis points, some of 50, some were intra-meeting, so before they even had the meeting, they raised rates. That's when the bond market really got hit. And we're seeing something very similar now, right? There is an absolute relationship. When rates go up, right, the value of our bonds go down. And if you've been invested for a while in an allocated portfolio, you've been using stocks and bonds together with the thought that when one goes up, the other goes down, and we offset and we have lower correlation. All true, but not all the time. Right? In a year like this, we have what? The stock market down. And what else is down? Bonds are down. Huh, there's nowhere to hide. That's why we said before that the other unnamed fund company you talked about losing money, well, we're all in the same boat. This isn't a situation that we can stay out of. We can mitigate loss and we can manage risk, but in many cases we're in a situation that's really a tough time right now. But let's understand where we are, right? The job of the Fed is, one of them, is to make sure inflation doesn't run away. We can argue that they were late to the game. We can argue that they're using a sledgehammer to kill the fly on my head, right? I mean, right? But in essence, that's going to happen. It'll take some time, it'll take some pain, and we've already seen it now. But think about this. Historically, what's the worst month in the stock market? Any guess? Spookiest month? October. October. If we went all the way back to 1929, stock market crash occurred in October. Go back to 1987, 35 years ago, October 19th. We'll talk about this date again in a few minutes. That was when Black Monday occurred, and that was a situation where the stock market was pummeled. So October, well, what if this year, in a bad year like this, you just tried to get out of the way and didn't invest in October? Any idea what would have happened? Just last month, and it wasn't on the news that much, was it? The Dow Jones Industrial Average last month in October was up 14%. 14 in a month, right? The S&P 500, which is a better reflection of the overall stock market because it encompasses more sectors and a better 8%. Annualize that, that's 96% over the course of a year. October was a great month to be an investor. So often we're going to try to outsmart the market and we're going to miss out on some of the best days. And I'll show you in an illustration exactly how important that is. Does that all make sense so far? So understanding market movements and the fact that we can't have a gain without some degree of loss, that's how the stock market has worked and will continue to work. Okay. If you flip the page here to number 2, volatility is normal. It is. Sometimes it's more volatile times than others. And we're in one of those periods now where we're having swings in the markets that are pretty uncomfortable. In this case, we're going back even farther. We're going back to 1940. All the way on the left is World War II, right? Right? Think about that. I couldn't tell you much about the music back then. Some swing stuff, I guess. I don't know. But that first leg up, you see the blue line on the left that goes up for about 4 years? That is a prototypical bull market right there. Lasting about 4 years, what we have is starting at a low point and just continuing to proceed upward. But then what? There's a red line down. The blue represents bull market, the red bear. Okay. A few years ago, my son was taking a course in high school in economics. I don't want to tell you his grade, but I came home from a trip one time and he said to me, "Hey, Dad, we learned about bull markets and bear markets." Oh, yeah, that's what we talk about all the time. Yes, if I knew why it was called that. I didn't know. He said, "Oh, it's because bulls go upward when they attack and bears go down, so it's up market and a down market." I'm like, get out of here. I need a drink. He's teaching me. Anyway, so that's a good way to keep it in mind. But if you go from left to right, you're going to see blue lines that are larger than the red. But what I'd ask you to do is if you all have your protractors, pull those out so you can measure the angles. Yeah. The red lines are much more precipitous, right? They're more dramatic. They're shorter. Matter of fact, bear markets last about a year versus 4 years for a bull. So a quarter of the time, I can live with that. But what's really difficult is that precipitous drop. And you know this. On the news, if it bleeds, it leads. They didn't make a big deal about how strong October was. But believe me, when the markets fall off the side, there's a lot of great words they use to describe how we lose money in the markets, right? So That's one of the other things we need to continue to keep in mind is that volatility isn't going away. This is normal. This is how it happens, and it's happened going back, in this case, 80 plus years. Okay? The blue and the red boxes there, just to keep that in mind, the average bull market gives you a return of 138.5%. It happens over the course of about 4 years. And the average bear, where we'd lose around 30%. So quite often when we're in the middle of a bear market, you say, okay, how much lower can we go? It's good to keep this benchmark in mind. There is no floor, there's no guarantee. We don't know how low it's gonna go, but it's good to know, okay, the average is around 30 and the average length is about a year. Fair enough? We came out of, after the global financial crisis in 2008 and into 2009, an 11-year bull market. That's longer than any on this page here. People were calling it a buffalo market because it was so old and hairy. Yeah, this was a situation where we were way overdue for a correction, if not a bear market. COVID gave us that in spades, right? And boom, it just nailed us really quickly. Unfortunately, though, we also bounced out of it incredibly quickly. Much of the reason that we bounced out of that has to do with why we have inflation where we are now and the rest. So not to go too deep, we'd expect some more volatility. And it's why we're big proponents of having good quality companies in your portfolios. Some of the biggest names in stock in investing over the last few years have been the most speculative. You might have heard of like GameStop and AMC and Bitcoin, right? And the rest of this stuff. Please check the prices of those. Just check on those things. What goes up that fast can come down just as fast. All right, we want good quality companies in our portfolios and hold them for a long time. All right, flip the page, please, to page 3. This is where we have to take a look inward. All right, give you a little background here. Our biggest enemy when it comes to our investing success quite often is ourselves. Okay? If you want to write down this name, Daniel Kahneman. Anybody ever hear of this gentleman? Kahneman. Sure. Kahneman. Daniel's a interesting guy. Older guy, professor at Princeton University, and 20 years ago, 2002, won the Nobel Prize in Economics. Snoozeville, I don't know, that's pretty boring, right? Here's the kicker. No background in economics, he's a psychologist. And what he did was pioneer this thought called, or a school of thought called behavioral finance, in which he decides and describes how we will do the wrong things at all the wrong times when it comes to investing. Go down the street and Harris Teeter's going to have 6 rolls of paper towel for $1 when they're usually $2 each, right? How much are we going to put in our trunk? As much as we can fit. Stock market drops like that, what do? I'm out. I got to get out of the way. Yet it's something we should be buying for the next 30, 40 years in many cases. We should be stocking up, right? All these theories, and Daniel Kahneman has written some incredible books. Some of his more recent pieces are really, I like it because it's a little bit easier to understand. I'm not a Princeton guy, right? But I think if we understand so much of this work that's been done, it's the fact that left to our own devices, we'll quite often make mistakes. These are the things that protect us in our lives, right? Put your hand on a hot stove when you're 10 years old. You ever do it again? Buy a stock when you're 25 years old at 50 and it drops to 10. Will you ever buy stocks again? It's the same kind of thing. It's that same thing. And we need to overcome that. That's why partnering with a financial advisor isn't a nice thing. It's crucial. I don't know of any high net worth investor or foundation or endowment that says, you know, I'll just use my phone. I can do it on my own. Absolutely need a good professional advisor with you. And I know Ben's in that category and he can help you out with that. All right, so that whole idea of behavioral finance, if you wanted to kind of check in on that, that validates so much my biggest conviction that this is not a do-it-yourselfer game. Lowe's and Home Depot are terrific if you want to do a little project over the weekend. Usually I've got to go 3 or 4 times. I always get something wrong. I measure, just this weekend I did that. I measured wrong. Anyway, that's okay. I fixed it. Lost an hour on a Saturday, no big deal. Try that with your retirement account, right? It's not a do-it-yourselfer project. Okay. Flipping one more time to page 4. And this is where I think we want to get a little bit more granular here. I said before, about 3 out of every 4 years in the stock market, you'll make money. So if you've got an emergency fund and you need that money within a year, good place to invest it? No. No. You got a 1 in 4 chance of coming out negative, and there's no bottom, remember, to how negative you can go. And there are periods, and we look back, 02, 03, 04, when you get back to back to back negative years. Not predicting that, don't get me wrong. But we have to make sure, we really do, especially as CD rates start to climb up, we have to make sure not to misalign our investments, right? Our goals, especially long-term goals that need 20, 25 plus years, that's where we need to be investing in the stock market and not think about what the value is today. It's the number of shares, just what we were talking about. And buying more shares when the price goes down. Similarly, when you get CD rates in that 4 or 5% ballpark, right? Oh, this sounds pretty good. Don't forget where inflation is right now. It's eating up all of that and then some. Also, don't forget the fact that that CD's interest is what? Fully taxable. So you're not going to get all of that. All right, so these are some of the things I want you to consider. Time is so important when you're considering the different investments you're using. Don't mix up the short-term investments with your long-term goals and vice versa. Okay. What this slide shows is that if we increase time, right, if we look at the 5-year, the 10-year, and then the 20-year, these are rolling periods. So 1-year period, rolling periods give you 74% of the time a gain. When we look at the 5-year, it increases 83%. That's better. Okay. Certainly as we get over 90%, we'd like those odds, but now we'll get into that 20 years and more. We've never seen a rolling 20-year period in U.S. stock market history that's been negative. No guarantees, right? However, I think I like my chances for goals that are 20 plus years out to be fully invested. Make sense? Awesome. All right, put a pin in that. Any questions as we go on? Easier said than done, right? This all makes perfect sense. Let's flip over to this one. Calm, cool, and invested. Yeah, we got a very cold theme going on here. So cross-country skiers, mountain climbers. Of course. There you go. All right. If you would open up right here to page 4. Oh, why am I bringing this up? Why should I worry about inflation? Hold on. We put these in motion beginning of the year. We weren't really worried about inflation, so we had to get people to realize, hey, inflation's a real thing. You know it better than anybody right now, how real it is. My wife gets an early start on all this stuff, and she did a bunch of Thanksgiving food shopping already. Whoa. It's different this year. Yeah, so it's a lot different this year. And it's different in a lot of different categories, right? I mean, we're paying more for so many different things. The biggest price tag we see when we drive by it on the road is gas, right? We can't ignore that. And that tends to be very volatile and it's in our face, right? But it's the hidden forms of inflation. It's the other groceries, right? And you'll see that in the middle over the course of 20 years, how much these things will increase. And then it's the intangibles sometimes that are really expensive. College costs. Those costs are just absolutely absurd and astronomical. But as I said before, I've got 2 of them up there at App State. So knowing this 20 plus years ago, I started to get on with funding that whole vehicle, and it's incredibly important to do just that, because these are things that they're not going to get cheaper. And inflation typically has a way of kind of staying around for a while. I don't know if you remember this word from last year, transitory. Remember that word? Anytime inflation would come up in the news, you'd hear, oh, but it's transitory. And I never really knew that word. I majored in English, but I didn't know what that was. It was like, oh, it's here today and gone tomorrow, right? Well, it's here today and was here yesterday and last year as well. So this tends to be sticky, and it's why the Fed has been as busy as they have been. So if you could flip through, what I'd like to do is finish off with a case study. It's on page 12. We'll take a few minutes to go through this. Page 12, you see the picture there of Margie Reedy. Hypothetical, she's not real, that's an actress. She's a little, I want to take you back in time here. These 1976, remember the year? Bicentennial, tall ships in the harbor and all that great stuff, and it was a fun time. It was the year the Cowboys lost to the Steelers for the first time in the Super Bowl. It was a painful day, but here's why I want to bring this up. 1976, hypothetically speaking, we're using an investor's time frame here. Margie Reedy, picture of her up there, decides to take the advice of her advisor and starts dollar cost averaging, or putting $250 per month into the MFS Total Return Fund. It's not a commercial for the fund. It is a 60-40 portfolio, meaning 60% stocks, 40% bonds. So pretty representative of a lot of allocated portfolios. So she does this steadily, $250 a month, $3,000 a year, 1976 until October of 1987. Remember, October is a spooky month for the stock market. 1987, 35 years ago, nothing spookier. The market dropped over the course of a few days there, including that Black Monday, about 1,000 points. Market drops 1,000 points every other day now. What's the difference? Hold on, the numbers were a lot smaller then, right? That equates to about an 8,000 point drop today. Can you imagine if the Dow dropped 8,000 points and we sat down at this table tonight? Your phone would be buzzing, my phone would be buzzing, the screen's on there, wouldn't be on ESPN or CNBC with the scroll. It is louder than ever. We can't deny that, right? As I mentioned before, the behavioral finance part of this, working against ourselves in many cases, that noise is going to be loud. When it drops again, I'm not predicting 8,000, don't get me wrong, but we need to make sure that we don't do the wrong thing. Two Margies emerge. One who does the wrong thing. One who says, okay, I can't take it, I'm going to go to cash. I like the idea of putting money away, I'll do that, but I'll just put it in CDs. Okay. The other Margie decides, long-term money, I'm not retiring for another few years here, so I'm going to stay the course. The tale of two people could not be any different. If you look at this chart, right, you'll see from the left to right, you can see all the numbers, you can see exactly what the returns were. You'll see the green, this is on page 12. You'll see the green lines start to emerge. That's the cash. That's when she went into CDs. Going all the way over to the next page and scrolling over to 2002. 2002 is a point at which Margie decides to retire. So in 2002, she has put up a cumulative total of $81,000. Pretty good chunk of money to put away over that period of time, right? In the plan where she stayed with the fund, she has just under $500,000, $495,000. 81,000 start, 495 finish. Pretty good story. But even in cash, even if she went to CDs, that $81,000 tripled, right? Became $249,000. Okay, so I get it. It's twice the pool of money if I stayed the course. That's a big difference, right? It gets bigger. Turn the page. Because remember, in 2002, this is the point at which, what does she do? She retires. So she's not putting money back in anymore. She's not in the accumulation phase. She's in the distribution phase. She's taking assets out of this investment. What we show from left to right on page 14 is a little bit different. What we start out with, $550,000 at the end of 2003. You'll see that blue line there. If you work all the way across, I'm going to cut to the chase. Unfortunately, Margie passes the end of 2021. Remember, she's pretend, so we don't have to have any sympathy. I know, it's a shame. She's Christine, you killed her. Oh, I didn't mean to, but let's just be real here. But over the course of her retirement, by staying invested the entire time in this one fund, right? Over the course of her retirement, what she did was, and you'll see it on the right side, withdraw $622,000 over those 20-some years. It's 5% of her portfolio, adjusted 3% each year for inflation. Pretty reasonable distribution rate. She took some $600,000, and upon passing, guess what else happens? She had another $600,000 still left in the account that she could pass to her heirs. Real quick story on the other side, $250,000 if she had gone to cash, it would have depleted the entire portfolio, taken a lot less income, and left zero to her heirs. Why do I tell you this to finish on a bummer? Why did I do that? The decisions we make in times of duress or real stressful periods are going to be the ones that are most important. And we have to make sure that we don't fall prey to the things that fail that cause so many other investors to fail. Right? The difference is immense. It'll get noisier. I have no predictions for what's going to happen except for that. I will tell you it's going to continue to grow in noise, and we'll hear more about this. What we want to do is stay true to the timeless principles. All right? And you're on the last page I want to show you. Just right there. Flip that one more page, please. Why should I stick to the plan one more time? 20-year period ending December of 2021. If you'd stayed fully invested, you just invested in the S&P 500, a $10,000 investment would have grown to that $61,000. Okay. But what if I just took a vacation once in a while and pulled my money out? If I had missed the 10 best days, and remember, does this happen sometimes? Don't forget October was a pretty good month. And we could have said, I want to miss October this year. I'll sit this one out. Just by missing 10 days out of 20 years, your return's about half. And it gets worse from there. 10 days out of 20 years. It's why it's so important. Leave it alone. Compound interest has been said, right? We've heard this before about Einstein, about compound interest being the most powerful force in the universe. If it's left alone. If you pull it out, it doesn't work. All right. I'll take any questions. We can stay, and this is kind of fun because growing up, we always talked and ate at the same time. So this is great. This is like old home. But thank you so much. Yeah.
The jelly bean chart.
Yes.
What?
I call it the jelly bean chart. It's what Ben called it. Pages 8 and 9.
All right. What can you tell us about the jelly bean chart, Ben?
Well, this is the one that I love to talk to clients about because I'll say, "What's your favorite, investment today?" And invariably they're going to tell me, "Oh my gosh, I love Amazon." This is a few years ago, of course, but I love Amazon. I love Google. Or maybe in previous years they say, "Oh my gosh, I don't want to be in the stock market. I want to be in bonds." This is a great chart to show us every single asset class that gets tracked over a period of time. And we can look at this chart and tell us if we went all the way back to 2002 and then we came forward to 2021, we can see in each year which one did the best, which one did the worst, and everything in between. We'll also note that if we started up here in 2002, let's say with commodities, that even the next year, 2003, commodities was getting pretty beat up. And it came back in 2005, and look where it was in 06, very bottom. You're going to see that same trend with every single asset class on this chart. At the same time, if you look right in the middle, you see a nice little, darkish box that says diversified portfolio, which is basically a structure of all of those asset classes. And notice that throughout that time period, it's right there in the middle. So we use this chart. I use this with all my clients to say, tell me what you like the most, right? They're going to say, and let's follow it along. And they'll say, well, Ben, which one do you like the most? And I'll say, I like that diversified portfolio. Because that one kind of keeps me happy all the way through. I'm never doing the greatest, but I'm certainly never the worst. And And if I keep doing that throughout thick and thin, I'm gonna end up profiting out of that. That's really the jelly bean chart
Yeah,
in a nutshell.
it's great.
Thanks for that, Steve.
Oh, no problem.
I have so many, sometimes they're stupid questions, I apologize. So back 100 years ago when I was in college, they said that once you hit, I think 55, you're supposed to start moving 10% of your portfolio from stocks to bonds.
Right.
I might be older than that, and I haven't done that yet because bonds, anytime I invest in a bond, again, it goes down.
Right.
So is there a rule of thumb anymore?
You
for that?
remember the old rule of thumb, 100 minus your age?
Yes.
Right? And if that's the case, then at 55, we should be 45% stocks and 55% bonds. Hold on. This one size fits all thing doesn't work, right? It certainly doesn't work for investing. If that's the case, right, we're going to be really undershooting because a 55-year-old, let's put it this way, let's go to 65. A married couple at 65, there's a 50% chance that one of them is going to make it to age 90. That's 25 years later, and it's 35 from age 55. So we've got to make sure that we don't just go into something, like the formulas are fun. It might be a starting point, but that's when you want to get with your advisor and put it together.
Like I said, I learned that stuff a long time ago. I don't adhere to it. And then the other thing was when you retire, you take out 4% a year.
Right.
You were using 5% in this?
Yeah, we use a 5% number in there, 4% in many cases, people will go to that. There's also an illustration in the previous book that talks about using a 4% distribution too. So yeah, that 4 or 5%, I'd stick with 4 as the reasonable one, yeah.
Do you know what we're talking about with that? So in your invested assets, not counting your house and whatever, when you retire, you plan on taking 4% of whatever the amount of your investment account is every year, and that's what you live on. And there's supposed to be some percentage that like 89% of the people will not outlive their money by doing that. Of course, okay, again, not a financial planner, just why they're here. I got lots of old dusty thoughts in my head, so.
Carol, thank you. I think the first book, if you really wanted to dig deeply into that, the first book we went through, it's on number 7. And it shows taking a 4% withdrawal from a pool of money, the likelihood that you would not run out of money, right? Okay. And it goes from left to right on this chart, 100% stocks. All the way on the right is 100% bonds. And along the way, the different stops are different allocations. So 75% stocks, 25 and on through. And what you start to see is you can't, with 100% certainty, there's only very few that are in that high 90s in terms of if you take 4% out, 90+% chance that this money will last that period of time. It's not stocks and it's not bonds, it's both. It's putting them together. So to illustrate Ben's point with the jelly bean chart, that drive down the middle of the fairway is a lot safer than the one when you're off to the right or to the left.
So this isn't based on any amount in your fund.
Right. It's not based on the total sum amount. So $1 million or $100,000 because you're going to take 4% out.
Of whatever it is you have. So
Yeah.
if you have 100,000, that only gives you 4,000
Right, you take out
for the year.
the year.
Yep.
So that's why, for those of you who've been old-time clients of mine, I did the Dave Ramsey, I was an endorsed local provider. So I always stress to you guys that I want you debt-free when you retire, because if you still have debt, and by the way, they might disagree with me on this one. If you have debt, that's more money you have to have every month to pay off the bills. So I want you
That's right.
to have the lowest amount of bills. Now, when the market's booming, and if you have a market at 3%, then we'll say, Carol, come on, it's 3%, I can make them 8. It's like, and he's not wrong, but I'm conservative. I like being debt free, and I paid off my house years ago, and I will tell you, I could work at McDonald's and say, do you want fries with that, and I know I can pay off my bills. So that's a freedom.
Yep.
So,
And just for the record, I would concur with that. I mean, I don't hate that, but I think that's one of the biggest drags on your success.
Yeah.
You know, there's so many things we can get into with that, but at the end of the day, it's so much better if you're just debt free because you have so much more freedom with your money and where you put it. It really does help.
I will to 100 to pay this off. And he just looked at me like I had 3 heads. And I don't know if it was him or the bank that was the bigger optimist, but it's like, okay, you have a 30-year mortgage, you're in your 70s, woohoo!
Yeah.
So, I mean, there's all different opinions, and everyone has, and we all have the same journey, we're all at different steps, we all have different goals. But, you know, the whole purpose of this is so we can make educated choices instead of reacting
Yeah.
to what somebody tells us. You know, I've had clients come in and say, my hairdresser told me I could write off this. I could write off my car if I put a sign on it. And I'm like, no, it doesn't work that way. Well, my hairdresser did. Well, maybe you should go see your hairdresser for taxes. I don't know. and if you go online, everybody's telling you buy this, sell that, do
Yeah.
this. And we need the experts because, you know, again, if I give you stock advice, just watch it go down. I mean, because I'm not in the market every day. So we need the experts.
Yep.
You know, I wish it was me, but my head's not big enough to do it all. So, you know, I meet well, it's supposed to be every quarter, I meet about twice a year. Because I need to be held on target. I need to be held accountable.
Mhm.
And so that's kind of what we're trying to find here is accountability partners. So that everybody can walk down, again, we all have the same goal. By the way, I used to plan that I would die at 80, then 85. Currently my thing is up to 95. I might be pushing me to 100. Like when will I have to start eating Alpo? So far I'm good to 95. but these are real fears. And for the younger people, Social Security is a question. I personally think it'll always be there because I don't think any politician's stupid enough to get rid of it. But I run my numbers with and without it, just to be
Yeah.
sure. And that'll probably be another class that we'll have. We've had it before on how to take Social Security. Because there's a plan for that. You can't just go and say, oh, I think I'll take it now. Because depending on your life expectancy, that'll be a whole different calculation. So things aren't as easy as they were in our parents' and our grandparents' generation. So it's confusing.
Well, thinking about your, kind of where I think you were going with that was years ago, and Stephen might remember this too. I know when me and Stephen started a business that they used to say you could take 6% as your
Yep.
default, and you'd be perfectly okay. Well, then you started having things like 08
Mhm.
that took the market down, considerably, and so you've seen this reduction in what kind of, what's a safe percentage to take out. So that's kind of changed over time. That 4% is kind of like and like Steve said, that's not a hard and fast rule. Everybody's different, but we kind of arrived at that and say, what's going to be comfortable for you. And then of course we want to employ, Carol when we have those conversations because we want to think about how do I do that in the most tax efficient manner.
That's right.
So the more staying in my pocket and not so much going to the government. So unless you're, into those kind of things. But that's where I like to bring Carol in and talk to my clients to say, let's make sure when we start taking this money out that you're doing it appropriately so you're not getting killed.
Yep.
From a tax standpoint.
And that gets a little important too when you're looking at getting close to taking Medicare out. Because sometimes if you take money and you roll it over, then it bumps up your income, and then when you go to pay for your Medicare premiums, they'll be doubled and tripled. So you
Yeah.
can't just look at one piece of the pie. It's very much integrated. So what is that Medicare thing? When they raise the rate? Yeah, so like a normal person will pay one thing, but if you have high income, you can do triple.
Was it Irma?
Irma, thank you, thank you. So there's, the government, it's funny, you pay into something your whole life, you think you have something, and then
changing those
Yeah,
or not changing them.
it's a good point. As far as the family, it's 70 plus, but in that case, it's a diversified portfolio. So what we're using in that illustration is equal portions of all those other asset classes, which is a pretty, basic allocation. Ben would put together a plan that's a little bit more complex than that. But that whole idea, you'd want to rebalance that. And we didn't talk too much today about rebalancing, but that's quite often the step that do-it-yourselfers miss the most. What's rebalancing? End of the year, we look at the portfolio, and what do? We try to get back into our original balance. If we were 60% stocks, 40% bonds, stock market did really well, we might be up to 70-30. We want to trim it back to 60-40. Why? A couple of things. If we're 70-30, remember, we're actually taking on more risk than we needed to. So we need to pull that back. So who would ever fight that? Think about it. You're going to look at your statement and the stocks and the funds that are up, that are doing well, you're selling those. You're going to get rid of those. And you're going to buy the things that didn't do so well. Once again, a little counterintuitive. I like to buy the winners and sell the losers, right? No, in this case, we want to sell those winners and buy more of the losers. And that's why that step is so often neglected. It's the process of rebalancing. And it's incredibly important.
What are your thoughts on robo-advisors?
Robo-advisors? They're great for robots, when the robots need advice. And
I'm just saying Betterment's been, we've been in Betterment for a while.
Mhm.
We like it.
It's there for a reason. Some people are going to gravitate towards that type of AI or technology that we never would have dreamed of in the past. We have access to all of it. Personally and professionally, from the years I've had, I fully believe the advisor is more than worth the fee they charge. The fees too, remember, these aren't excessive, outrageous fees. The industry is compressed a ton. There's a lot of oversight. There's still some other firms on the side here, but that's why I'm an Edward Jones client. That's why I'm very confident this is a great place to invest for the long term.
I'll just say, just from a personal standpoint, as Steve said, everybody's got their own. I mean, there are do-it-yourselfers, that feel confident. There's the robo-advisor. The difference is the robo-advisor does not call you when you're going through a market like this to say, hold the course. And they're not doing any real planning with you. They're not really talking to Carol and saying, when Steve talked about, the ups and downs of the markets, one of the things that some of my clients probably don't really necessarily like to hear from me now is when we start talking about tax loss harvesting. Let's take advantage of all these losses.
Yeah.
Why would I want to do that? Because again, you don't have to pay the government as much money when we take advantage of those kind of things. That's a great strategy that a robo-advisor is never going to call you and talk about, because that's not how they're structured. So
Yeah.
just kind of a takeaway there.
And that tax loss harvesting, the idea of selling something, Steve, I thought you said stay the course. You're still staying the course. It's almost like having a game plan in a football game, and you call an audible once in a while, but you still stay within the game plan. Tax loss harvesting is one of these things that you can do so that you can actually pay less in taxes, but stay fully invested. It's a great tool. It's again, like rebalancing would be for the do-it-yourself investor. It's one of the things that's ignored by folks who do it yourself as well.
We're talking about things that are ignored. So one thing I like to do at this time of year, and I promise the three of us like what we do, so we could go on all night long. We won't bore you forever. But if some of your investments have gone down in value, sometimes it's a great time to move everything to a Roth IRA or to move some. So we know what your income is. It's November. Let's see how much room we have before you move up to the next tax bracket. Let's move something that's down to $25,000 into a Roth IRA. Then when it bounces back up, you have $50,000. It won't be taxed when you take it out. So it's like, woo-hoo. So, okay, I like what I do. But it's just, it's a smart plan to put in effect now. So if you have something, and again, I keep just fine putting my money in every payday, is everything's on sale. So if the idea is that it's a depressed value, but we reasonably comfortable it's going to come up, if we move it to something, so we're going to take the tax hit now, but when it goes back to normal, you just got all that for free. And if you're my client, you've heard me say free is for me, probably too many times, but if you can get a capital gain for not much to pay for it, just something to kind of think about. This is the end of the year is when we typically do them, because December 31st is coming. But something for you to think about. You know, anyway, I'm sorry, I love these things. And obviously, I don't sell them, I don't do anything with them. I say, I'll do the math calculations for you and say, okay, you've got this much room. And I always try back off 1,000 or 2,000 just so we don't push over, because sometimes something else will come in. The other thing I do want to remind everybody, if you invest at this time of year and you invest in a personal account, not a retirement account, a lot of times you get your money back as capital gains. So be careful of that. So you're going to want to talk to them and make sure that you don't invest on Tuesday and then on Thursday you get your money back as capital gains.
Yes.
So.
Window, right? You have to wait.
Well, and every fund's at a different time, right?
It is.
They're
Yeah.
all at the end of
Yeah.
the year,
That's
just,
right,
just
yeah.
to drive me crazy.
I know. We do that.
That's again, because
But yes, that is a consideration, absolutely.
but there's a lot of pieces. Sorry.
Question on, let's say, hypothetical, somebody getting close to being able to withdraw from Social Security, and they have an IRA,
Mm-hmm.
but they want to take one or the other. From what I've been, a little bit of research, someone's saying take the Social Security at 62, then let the IRA grow.
Mm-hmm.
But other people say just the opposite.
Right.
Which one?
This
I know it's
this is
individual
tax
situation.
stuff, right? All I know is the IRA is the IOU to the IRS. You're gonna have to pay them, and if it keeps bigger and bigger,
So my
There.
big thing is, I typically, 99% of the time, will tell you take the money from the IRA and let Social Security grow, 'cause it'll grow by 8% a year. Now, I always have this horrible discussion with, so how long did mom live? How long did dad live? Do you have any long-term health care issues? So if you have emphysema and stuff, I'm saying, yeah, maybe you should take it now, because maybe your life expectancy isn't as long as we think it's gonna be. But, if you were in reasonable health, I would tell you to take the 401k money and then let the Social Security grow, because it's guaranteed. And we're also gonna get guaranteed 8%.
exactly.
Now, we're
Yep.
leaving-
I'm right in that, you know, because it is personal, right? It depends on every person's situation, but in general, as Carol said, if I take Social Security too early, I'm locking in a lower payment.
Right.
So the issue kind of comes into, you know, because if you can stretch it out until 70, you're getting the maximum Social Security
Yeah.
payment. So taking it from the IRA, you know, might be the better option until you get a little bit later on.
But a lot of people are not making it much past 70 to benefit because of having waited.
That's why we want to look at your family longevity and,
Yep.
and see how you are. Like I said, it's always an awkward discussion for me. I feel like I'm getting, I mean, not that I don't know everything about y'all anyway, but let me go ahead and get your health information too. But, you know, so you make an informed choice. Again, I've had people who have emphysema and have other health issues. It's like, take it in and enjoy as much as you can. The other thing that I like is if you have that Roth IRA, that's the tax-free money that can kind of get you over that little bump and lump. So you've got your budget, and then something unexpected happens. Now you've got Roth IRA money you can take out and not have to pay taxes on it, so you don't have to worry about what's Carol gonna say, what do I have to set aside for taxes? It's free. And by the other way, one more commercial for y'all. If you have an HSA at work and you're able to put money into it, that's another great way. It's all pre-tax. Most HSAs, once you have about 200-300 in it, will let you invest the money. So it's what we have at my office. So, I mean, you know, you can invest in interest and CDs and bonds and what have you. Another way, pre-tax, it grows. You can't put into it once you have Medicare, but as much as you can build, do it now, and you can use that money the rest of your life. Tax rate, which, again, you know, that
It's just for medical expenses.
that's
Yes.
right.
And you can't pay premiums out of it.
That's right.
Right.
I didn't think you guys had costs. And you were about to say something earlier. I'm so sorry.
Yeah, I was wondering, according to the insurance, is it bear market usually lasts about a year, thereabouts.
Right.
Using your crystal ball, when do you think the clock starts?
On this one, I think you'd probably go back the early part of this year. You know, and we can measure it, and we can find out when the market really was 20% down from the previous high, and that would tell us. But it's probably the earlier part of the year. I would, and what I've been telling folks lately, I would just prepare for a longer bear market. That's the average. I really want to be careful of averages, right? So we want to make sure that we're ready for it if it's 24 months, if it's 36 months, right? We saw that 2002, 3, and 4, and there have been periods like that. But if we're prepared for it, we can invest properly for it, we can adjust the investments themselves if our goals have changed, but yeah, my crystal ball's broken. I don't know. Just can't get it going.
I think I want